Hello and welcome. This is Bennett Tchaikovsky. This is Accounting with Bennett Tchaikovsky, and our topic today is going to be inventory costing. This presentation is copyright 2008-2018 by Bennett Tchaikovsky. All rights are reserved. So let's kind of take an overview in terms of what we're trying to accomplish with inventory costing. And we've looked at when we are selling inventory as opposed to, providing services, our transaction looks a little bit different, right? And the reason why that is that this top part right here of accounts receivable, and then over here with sales revenue, you can pretty much replace this with services revenue if we're providing something on account. But this is that second part down here is when we are selling inventory, it looks a little bit different. And the reason why is because when we're selling a product, really two things are happening. I'm either receiving cash or a promise to have a company ultimately pay me, which is accounts receivable. And I also need to show that inventory coming off of my books. And when I'm doing that, when I'm showing that inventory, it's coming off my books, I'm basically debiting cost of goods sold, which is considered to be a selling expense. Okay. So with that being said, when we're looking at our inventory T account, we're going to be starting here with our beginning inventory. And when we add in our purchases, this is giving us our gas or our goods available for sale. And as we just saw below, when we sell inventory, what we're going to need to do is basically take it off the books. And basically we'll see here sold inventory. And this is over here is going to be going over to our cost of goods sold, or basically I should say this is inventory sold is going to come over here to our cost of goods sold. And what is that going to be leaving us with? It's going to be leaving us with our ending inventory. And this is an extremely important relationship. And not as important as those on The Bachelor or Bachelorette, which last forever, but this is an extremely important relationship because we have goods available for sale, which is my beginning inventory, plus my purchases during that particular accounting period gives me gas, right, or goods available for sale, less what I sold, right? So when I'm selling inventory, I've got to take it off of my books. It's going to cost of goods sold, is giving me my ending inventory. So as we go through and complete these problems, what we're going to be asked for is, depending on the particular method, we're going to be asked for cost of goods sold, which is really this part right here, and we're going to be asked for the ending inventory. Now, you're only going to have to complete one. You don't have to do both, although at first when you are approaching these problems, I would actually recommend doing it both ways. Let's go to our inventory costing methods. Now, depending on how psychotic your accounting instructor is, you may have more or less of these, but let's go ahead and take a look at them all anyways. FIFO periodic, FIFO perpetual, LIFO periodic, LIFO perpetual, weighted average periodic, moving average perpetual, dollar value LIFO, and specific identification. The ones I'm going to be covering over these next few videos are going to be FIFO periodic, FIFO perpetual, LIFO periodic, LIFO perpetual, weighted average periodic, moving average perpetual, dollar value LIFO. This is going to really be an intermediate accounting. And specific identification, this is really going to be, I'm not going to be covering this here. Specific identification is really used for, say, something like a jewelry store. And if a customer is buying a particular item, the cost of that item, because it is so unique, okay, that you can actually go back and trace that cost to that specific item. So what do all of these different things mean? FIFO means first in, first out. What does that mean? The first inventory in and their related costs are going to be the first that are expensed to cost of goods sold. Last in, first out means that the most recent purchases are going to be the first that get expensed to cost of goods sold. And when you look at these methods, in terms of FIFO, the cost of goods sold number will be older inventory. However, the balance sheet will reflect the newer dollar values of inventory. Okay, and what do I mean by that? If we're taking our first goods that are coming in and expensing those to cost of goods sold, what's going to be left? It's going to be my ending inventory. It's going to be my most recent purchases. So my cost of goods sold number is going to show those earlier initial purchases, while my balance sheet is going to be a little bit more current. Last in, first out is my cost of goods sold number reflects current inventory purchases. What does that mean? It means that my income statement will be more current in terms of that cost of goods sold expense. But conversely, what happens to my balance sheet? For my balance sheet will have older inventory values. So again, first in, first out, it's a cost flow assumption. The first goods in are the first ones that are expensed to cost of goods sold. My cost of goods sold number, therefore, is going to reflect older inventory. Why? The first goods, or that very first inventory balance, will be the first one that's going to be expensed to cost of goods sold. However, my balance sheet is going to be more current because my older inventory has already been expensed. Conversely, last in, first out means that the last goods in are the first ones expensed to cost of goods sold. So my cost of goods sold number will reflect my current inventory purchases. However, and my income statement will be more current because that cost of goods sold number is going to be more up to date. But my balance sheet is going to have older inventory values. Okay, and that is really much more the subject of dollar value LIFO, which you will discover in intermediate accounting. And as far as what does periodic and what does perpetual mean? Periodic means that I disregard the dates of sale, disregard the individual sale dates. I assume that all of the sales happened at the very end of the month. And I go through and compute FIFO and LIFO using that assumption. Perpetual, on the other hand, is that the dates do in fact matter. So what I need to do is to go in chronological order. I never go into the future. Very, very important, unless I have a hot tub time machine. And if you have one of those, please find me. So if I'm doing something that's perpetual, the dates matter. And so I'm going to go chronologically by date. I'm going to look at each sale in the order it happened and then determine what goes into cost of goods sold at that point in time. What's really important to remember is that when we are doing inventory costing, it is not a physical flow assumption. And I always love this because they say, oh yeah, like milk or like food, it's, first in, first out. And, we all know that when we're going for that milk carton, we're going for the one that has the very far in the back that has like the dates that's far in the future. So we don't have to worry about it expiring, but it's not about the physical flow assumption. It's really a cost flow assumption that we're using in terms of pricing out our inventory. The other part of this, which is very important to recognize, is we need to be consistent, right? Once we choose a method, if we choose FIFO periodic, we need to be staying with FIFO periodic. Why is that? Well, if I could change every single year, well, this year I'm going to be FIFO periodic because it's giving me this great number. And then next year I'm going to use LIFO perpetual because it gives me a better number. And I can't do that. I have to be consistent. Once I choose a method, I have to be consistent. I have to stay with it. And, can we change our method? Sure. That's a topic for intermediate accounting. That's not what we're doing here today. And lastly, as far as what method should I be using? What we really want to be doing is we want to take a look at the particular industry that we're in to see if, well, is everybody else using one thing? If I'm Target or Target and I'm using, LIFO perpetual, but Walmart, Amazon, and all these other major retailers are using FIFO perpetual, it may raise questions. So it's very important for us that when we're choosing a method, we kind of want to keep that in mind and get an understanding in terms of why we're choosing that cost flow assumption to make sure it makes sense with our business. So what I'm going to be doing is working through a particular problem, which is right here, and this is OAI. And this particular problem, we're going to work through all of the different methods. And I'm going to try to keep it in terms of having essentially a couple different parts. And so what I want to do on this first part here is to show you the constants. Now, when we're going back here and looking at this overview, this goods available for sale, in terms of looking at it as far as goods available for sale, this number is always going to be the same for no matter what method we choose to go through and use. Okay, very, very important. Goods available for sale, no matter what method we choose, will always be the same. When we're doing inventory costing, we're really just trying to figure out, okay, these are my goods available for sale. How do I determine that amount that's going to be going to cost of goods sold? And then what am I going to be having remaining in my ending inventory? So this constant right here in terms of goods available for sale is a very important number to compute because it will be the same for everywhere. So how do I go through and do it? Now, what's important to remember is that when you come into, my exam or an accounting exam, depending on how they have it set up, the only information you're going to be generally be given is this information right here. I know textbooks like to give you more information, but that's not fun. This is much more fun. So the first thing I needed to figure out and do is what are my goods available for sale? And what does that mean? Well, if we go back here, what are goods available for sale? It is my beginning inventory plus my purchases. So right here, if I take my units and then my cost per unit, what I'm going to do is I'm going to take 10,000 times $1.25 and what did we do? Wow, that was close. Right here, then I'm going to basically take 5,000 times $2 per share. Then I'm going to basically be taking 2,000 times 250. Then I'm going to be taking 4,000 times 4. Then I'm going to be taking 5,000 times $5 cost per unit. So what I'm doing here is I'm going to add up all of these amounts here. And I'm going to get a total here of 68,500. Okay. So my goods available for sale, and this again will never change depending on basic for any of the questions that we're going to be doing, will always be 68,500, okay? And so right here, let's go give this a new, brand new color. There we go, beautiful, okay. The other thing that's not going to change, and it's also really kind of important to recognize this, is the number of units. And what I'm referring to are the units available for sale, the total number of units sold, and lastly, we're going to be computing those units in ending inventory. And if I can kind of borrow from what I was doing right over here, so here in my inventory account, if I'm looking at this in terms of units, I have my beginning inventory in terms of units, plus my purchases is going to be giving me my total units available for sale, less my units sold will be giving me my units in ending inventory. So when I look at this example right here, okay. There we go, Tchaikovsky, great work. Let's keep going there. It's really great preparation, good job there. Okay, so when I look at this for this problem here, right, my total units available for sale will be the 10,000 from my beginning inventory, plus my 5,000 here, plus my 2,000 here, 4,000 plus 5,000, or a total here of 26,000. Okay, so my units available for sale, meaning how many units did I have available to actually sell, is going to be 26,000 units. So, and if I put this in terms of the T account that I just kind of created down here, I'm going to have my beginning inventory units plus my purchases, which are right here, plus 5, plus 2, plus 4, plus 5. So my total units available for sale, again, this is in units, we're not talking about dollars, is going to be 26,000. So how do I determine my units sold? Well, right over here, when I'm looking at my accounts, I've got this over here. I've got basically 7,000 plus 6,000 plus 3,000 units is giving me a total of 16,000 units. So the number of units that I've sold is going to be 16,000. So if I have 26,000 units available for sale and I sold 16,000 units, how many units do I have in ending inventory? Well, that is going to be 10,000 units, or 26,000 units minus the 10,000 units, minus the 16,000 units sold. Okay, will give me a total of 10,000. So in all of these different methods that we're going to be doing, these numbers here will never change. The total number of units sold is all going to be the same. Total units in ending inventory will always be the same. Units available for sale will always be the same. These don't change, and that's why we're calling them the constants. So the last thing I need to compute are my total sales dollars. How do I figure that out? Well, I'm going to take my total units sold, which we'll call letter D. I'm going to multiply that by my sales price per unit, which we'll just call here sales. So we're going to have 7,000 times 10, 6,000 times 12, 3,000 times 14, or when I add these up, 70,000 plus 72 plus 42, I'm going to get a total of $184,000. So those are my total sales. And again, this number will not change for no matter what inventory method that we end up using. It will always be the same. So again, in summary, what we're learning here is we're going to be going through and doing different inventory methods, and we're going to get to those in the next video presentation. But what we're going to be learning is about FIFO and LIFO, weighted average and moving average, basically perpetual and periodic. And the important thing to remember is what we're trying to figure out is what dollar amounts are we going to be putting in here into my cost of goods sold? How do we determine the value of inventory that's going into cost of goods sold? Because notice here, my units aren't ever changing. I'm still selling 26,000 units. I'm still selling 16,000 units. I have 26,000 units available for sale. I have 10,000 units remaining. But depending on the cost flow assumption that I'm using for these various different problems, that is going to determine my cost of goods sold under the various different methods. So I'll end this presentation here, and I will be doing a subsequent presentation that will be talking about the periodic methods and FIFO perpetual. Thank you.